Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to do a review of everything that we learned here in the month of June. Today we're going to talk about the strategies that we talked about, specifically about how to select optimal expiration dates and strike prices, as well as a review of what I consider one of the most important topics of our education, which is really trading psychology and risk management. So we'll go do a quick review of all of those things and then talk about those things in the context of the real markets. And that's really the strategy that we want to utilize here for all education, where we don't just fly through education and keep going with new education. We always take time to revisit the education that we went through over the past month and make sure we help you apply it to the real markets. So we'll talk a little bit about how we're viewing the markets. You know, we're at a pretty pivotal point in the markets. Things have been slowing down over the past couple of weeks. There have been a lot of concern from investors as far as whether or not we were going to get a pullback or perhaps another correction as the number of COVID-19 cases spike in many states and also globally. So we want to try to answer some of those questions as far as how we're viewing the markets, and then more importantly, how we view the markets and utilize the things that we've learned to trade these current markets. So let's go ahead and get started. Now, before I do, just a quick disclaimer, what we're going to discuss here today is purely for informational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start by doing a little bit of a market update where we currently see the markets. For those of you that want to get more of that, please make sure that you join us on Tuesday and Friday morning market outlook sessions that we do at 9 a.m. Eastern every single Tuesday and Friday. So we'll talk a little bit about the market update and what option strategies we're currently utilizing to play this particular market environment. Then we'll do a quick review of trading psychology and the risk management aspect of things, which again, for those of you that missed it, I do think this is one of the most important topics for you to learn and make sure that you brush up on. So if you missed that session, today we'll do a quick review. And then if you find that interesting, I highly recommend that you go back and watch that recording. Then we'll talk a little bit about expiration dates and strike prices. So as we go through the market update and we talk about some of the names that we're paying attention to, we'll talk about how we want to utilize option strategies and how we're selecting expiration dates and strike prices to play for those specific ideas. Then we'll do some market analysis together. You guys can submit some symbols for us to all take a look at together. And at the very end, we'll do a Q&A session to answer your questions from what we learned here today. So let's go ahead and get started. Now, the question that I predominantly want to help investors and answer at the moment is really, are the markets due for a correction? This is because of the number of questions that we've been getting along these lines. This is predominantly the concern that many investors have had as the markets pulled back over the past couple of weeks. So we want to try to answer these questions for you. And I do want to announce just a special webinar that we'll be doing next Wednesday. I'll be doing an Ask Me Anything session next Wednesday at 4:15 p.m. Because July 2nd is going to be right before the market holiday, the July 4th holiday, we won't be doing an education session next Thursday. So I do want to do a very special event next Wednesday where you can come and ask me just anything under the sun. You can submit your questions ahead of time by going to this link here, trade.optionsplay.com/AMA. If you are registered for this webinar, then you're already registered for that one. You'll get a notification for that. We will send out reminders. We will make sure that everyone is aware of how to attend that event. If you have not signed up for it, you can go to this link to sign up for it, but submit your questions ahead of time. The earlier you submit it, the likelier that I'll be able to address it during the session. You can submit any type of questions. It doesn't have to be related to options, doesn't have to be related to the markets. You can literally ask me anything. So I hope that you guys are able to join, and I hope that it's a little different type of session, a little fun session where we don't necessarily have to always talk about the markets, and you can come and ask me anything. So hope to see you guys there. So let's talk a little bit about what we learned over the past few weeks. Now, if everyone could please bring up your chat window, which is at the bottom of your screen. I just want to ask, how many people were able to attend the session where we talked about risk management? We talked about the difference between a finite and an infinite game. Please type yes into the chat window if you were able to attend, and no if you did not attend. Okay, so I see a ton of yeses, but also quite a few no's. So for those of you that did not attend, I highly recommend that you go back and take a look at that recording. But right now, what I'll do is just a quick 2-minute review of what we learned, because it's such an important topic that we spend the time to learn about this. But what we learned is that in life, so the premise of the education was around how do you manage risk, or how do you think about risk in your portfolio. And what I brought up was a theory written by an author called James P. Carse in 1986. Now, James was a religious philosopher. He was not a trader or a finance professional, but he had the insight that there are 2 types of games in the world. There are finite games and infinite games. Finite games are the types of games that we are all familiar with, games that have fixed set of rules. They end at a certain point, and at the end, there is declared either a winner or a loser. And these are games that we all know of. Basketball, football, chess, poker, all of these games are fixed rules. At the end, there's a winner or a loser. And in a finite game, your sole purpose, everything that you're trying to do, is win. That's the whole point of a finite game, is your goal is to win. Now, and it makes sense in these types of finite games. And on the flip side, we have what we call infinite games. Infinite games are defined as games that have no fixed upon rules. The game actually never ends, and there's no such thing as a winner or a loser. There are only players that are still in the game and players who drop out. And you drop out usually because you no longer have the resources to play, you no longer have the willpower to play, or you simply do not wish to play anymore. And examples of this, I think the primary examples are such as running a business. That's an example of an infinite game, because there's no such thing as winning in running a business. You can't win. Apple cannot win. Microsoft cannot win. One is either in business or no longer in business. Those are the only 2 possible outcomes. Such as running a casino. There's no such thing as winning when it comes to running a casino, or running the National Football League. You can win in a game of football, but you cannot win in the National Football League. The league itself cannot win. The league is either in power, if you will, or the dominant league, or it gets overcome by a smaller league. And trading, if you think about it, falls under the infinite game, because when we think about trading, and when we talk about trading, we're talking about your trading career, not just individual trades. Your trading career is a series of trades, and there's no such thing as winning or losing. You either have an account with enough capital to continue trading, or you've blown up your account, you no longer have enough resources to continue trading unless you redeposit or put in more money into your trading account. So when you realize this, the reason that we bring this up is because I get a lot of questions from users asking me the same question. And that is, I put on a trade, the trade went against me. What can I do to turn this trade around and turn this losing trade into a winner? And when I hear that question, what that reminds me of, this is someone who's too focused on winning, which means that they are playing what they think is a finite game, because they are thinking that if they win, they'll be able to be successful in trading. And what they don't realize is that they're trying to win in a game that has no winning. What you realize is that trading is something that your only goal is to make sure that you don't drop out. How do you drop out of trading? You drop out by blowing up your account. And ironically, in the pursuit of winning, in the pursuit of trying to turn every loser into a winner, what we tend to see is that investors take on more risk than they really intend on, because you have a trade that went against you. You could just cut the losses and move on to the next trade. But instead, what they do is, instead of investor, what they do is to try to turn that small loser back into a winner, they take on more risk. They add on risk, hoping to get their losing trade back to a winning trade, in thinking that if I do that, I'll be profitable. But in reality, what you're doing is you're losing sight of the bigger picture, which is make sure that I don't drop out at all costs, not win. Winning doesn't get you anywhere in terms of trading. Only by focusing on risk management and focusing on making sure that you don't blow up your account, that's the only way to truly, quote unquote, win in trading. So when you focus too much on winning, what ends up happening is an example that I went through during the session, which is something along the lines of a trader who believes that a stock is going to rise because they've realized that this is a support level, and they think that it's revisit that support level, so they're going to buy that stock. So they buy the stock, and what happens? The stock moves lower. Now, as someone who's focused, who realizes that they're playing the infinite game, generally speaking, as a professional trader, what you would say is that support level is no longer held. I was wrong on that trade. Let me cut my losses and move on to the next trade. But someone who's playing the finite game, who thinks that they're playing the finite game, would say, well, I have a loser on my hand, but how do I turn it back into a winner? And they think to themselves, okay, well, this original support level didn't hold, but maybe if I go back farther enough, there's another support level. So if I buy a little bit more, then maybe if the stock bounces, I'll be able to get myself back to break even. And what you do is you're so focused on winning, you forget the fact that now you're taking on double the amount of risk. And now you've doubled the risk of potentially blowing up your account, which is what you're trying to avoid when you're playing the infinite game. But when you're focused on the finite game, you lose track of the infinite game. And that is the struggle that I think most traders fall under, where this might be a simple example of that, but I've seen so many times where a trader takes the trade, doesn't take losses, adds on to the trade, adds more risk, and the trade keeps going south, and they start looking for new justifications for going long again, because at this point they've lost so much money, they have to figure out a way to get themselves back to break even, and they'll do desperate things to do so. And this series of events, while this might be a bit of an exaggeration, is really how every account blow up starts. It starts small usually. Start small, trade goes against you, you think to yourself, I'll add a little bit more, maybe get myself back to break even. Next thing you know, you're in a hole so large, you really can't afford to just simply let that loser go. So you really grasp at straws to get yourself back to break even. And unfortunately, this is how I see most traders blow up their accounts. And my goal here is to make sure that you guys have a framework to help you think through this again and think through how do you just cut your losses at a small loss and move on to the next stage. And hopefully this line of thinking about what type of game are you really playing helps shift your thinking in terms of how do you actually manage risk in your portfolio. So again, for those of you that missed it, I really encourage you to go back and watch that recording. I'll show you how to access that using our YouTube link after we finish here today. But it's very, very important that you learn this lesson that when you're trading an infinite game, or you're playing an infinite game, and your goal here is to make sure that you don't drop out, not winning. Winning doesn't get you anywhere in an infinite game, because there's no such thing as winning in an infinite game. And there are some fantastic talks on this particular topic of infinite versus finite games that really apply to so many other aspects of your life outside of trading. And, you know, it applies to your marriage, it applies to running a business. And once you realize this, it really changes your life in the way that you think about so many different things. So I highly recommend that for those of you that are interested in succeeding in trading, to spend some time and think about this and how you go about approaching your risk management. Okay. The second thing that we talked about was expiration dates and strike prices. We talked about how to select optimal expiration dates and strike prices. So one of the things that we talked about is that whenever you're selecting an expiration date, the theta decay, the rate at which the option decays in value, is the primary factor, if you will, in determining which expiration dates that you choose, because the longer dated options have low time decay and the shorter dated options have very fast decay. So whenever you're buying, generally speaking, what we learned is that you generally want to buy longer dated options, because longer dated options, even if you hold on to it for 1 month, will experience a smaller amount of time decay than if you were selling an option and for that same 1 month, where you would have a much larger amount of time decay. So what you really want is to have time decay work in your favor. So by buying an option with a longer amount of time decay has a smaller effect on your value of your option during that period of time. And if you're selling, you want to sell a shorter dated options, because you want the value of that option to actually decay at the fastest possible rate. Okay, so those are some of the things that we learned. And lastly, with respect to selecting strike prices, this is really where we talked about, if you're selling, you want to sell short dated out of the money options, because those have the fastest amount of time decay. And if you're buying, you want to generally buy longer dated in the money options, because those have the smallest amount of time decay. So that was a quick review of the things that we learned. So with that, what I'm going to do is I'm going to first go through a quick market update, just as far as what we're currently seeing in the markets. Then we'll take a look at a few different ideas and how we apply the things we've learned to what we're going to teach, what we've taught you over the past month. And then what we'll do is we'll open this up. We'll let you guys submit some symbols. We'll allow you guys to submit some questions, and we'll try to answer as many of those as possible and hopefully give you guys a better understanding of the things that we've learned here. So let me go ahead and switch this. So I'll start off by talking a little bit about where the current market is trading. And this is a quick review of what I will be going over tomorrow morning. This is what we spend 30 minutes every single Tuesday and Friday morning. For those of you that have not joined us yet, you can sign up for that by going to trade.optionsplay.com/weekly. For those of you that want to join us, I just posted that link into the chat window if you have not already signed up, where we spend 30 minutes before the market open on Tuesday and Friday mornings, where we just talk about where the markets are, what research we're currently reading, and how we're viewing the markets. And predominantly what we've been saying for the past few weeks is the fact that markets remain in this slightly bullish state. Yes, the correction that we saw or rather the consolidation we've seen over the past couple of weeks has taken a lot of the momentum out of the markets. But one of the things that we stressed is that markets still remain above its major resistance levels. So until it breaks below those resistance levels, it's not a good time to go out there and short the markets. We had a lot of questions regarding whether or not it's time to short the markets, whether it's time to start buying puts. And we predominantly kept saying, no, now is not the time. And we predominantly were looking at a few different things. Number one, S&P 500 was well above its major support level around 300, 302. We talked about the Qs remaining extremely strong, technology and biotech leading the markets higher, making all-time highs. We did mention here on Tuesday that we saw a bit of negative divergence on the daily chart. Now, markets did pull back as a result of that. So we mentioned this on Tuesday, and the markets did pull back as a result of that. So it somewhat resolved that negative divergence on the daily chart. And notice how every single time it touches the 20-day exponential moving average, it's been a buying opportunity. That's the same opportunity we currently see. Price action into the close was extremely strong, and that's the same opportunity that we currently see. So on the daily level, I would say this negative divergence has resolved itself, but the weekly chart remains fairly, fair amount of negative divergence. So we do see on the longer time scale, perhaps a higher probability of a pullback into this 220, 225 level here on this rising 20 week moving average. But that is some of the concerns that we do have. But the one thing I do want to point out is that when markets are overbought and you start to see negative divergence, that in itself does not tell you, number one, when it's going to correct, and it doesn't tell you how far it's going to correct. So those are two things to remember. And that's why we kept saying now is not the time to go out there and buy puts. If you did buy puts, make sure that you take profits on those very, very quickly. That's the only way to trade short-term plays on this market. As you can see, even a violent pullback here only lasted 2 trading sessions. It's very, very difficult to time that, to get it exactly right, where you pull the trigger at the very top and get out the very bottom. That is a much more difficult proposition than to buy every single dip that you see. So our base case at the moment is still buy the dips, especially when the markets are above its major moving averages. And one of the things that we've been talking about heavily over the past few months is really the fact that the market rally we're currently seeing is very healthy. And that's predominantly by looking at small caps. That's predominantly looking at the equal weight index. So S&P 500 is up about 1%. Small caps are up 1.4%. So I will say that this index started to lag behind this week, but looks like it's starting to catch up again. So perhaps the health of this rally is coming back. Equal weight index up 1% today, but also this is a segment of the market that was starting to underperform. That was a concern. So we did see some cracks, if you will, in the rally this week. But the fact that it remains above its support level, these are still indications that we are in this cautiously bullish buy the dip type mentality, and the markets are still in that particular mentality. I will say that the momentum has been shifted quite a bit to the more neutral in terms of momentum. So right now we're not taking any overly bullish or overly bearish views. We're predominantly selling, especially when VIX still remains fairly elevated. VIX is still trading at 32. So we see that volatility is still high. This is the type of opportunity to sell volatility, selling credit spreads. Those are the types of trades that you've been seeing us play during daily plays, and that is how we're playing the market. So that's just a very quick overview of how we're currently looking at the markets. So based on that, our views is still, despite the spike in COVID cases, which absolutely is a concern and certainly adds to downside risk, right? We're not saying that downside risk doesn't exist. It absolutely is there. But instead of outright buying puts, what we prefer to do is be more defensive, so that if stocks do sell off, or especially due to a rising case of COVID-19, we prefer to be long stocks that are going to do well in that type of environment. So think about the initial sell-off and the type of stocks that did well. Think about the food staple stocks. Think about the supermarket stocks. Think about consumer staples like Clorox. These are the types of names that we prefer looking at. And especially if you look at some of these charts, many of them from a technical perspective line up very well from the the fundamentals. So if you draw a line here around 210 here on Clorox, you had multiple 210 resulted as a resistance for multiple months, finally broke out, came back to retest that as support, and is now starting to move higher. So you have what I would consider a very strong technical setup here, and you line that up with being more defensive as new COVID-19 cases spike. Those are the types of plays that we would prefer to be long rather than trying to find short opportunities, especially after, you know, some of the stocks that are likely going to underperform in a COVID-19 environment. Those stocks are already down 20, 30%. Look at the airline stocks. They are difficult to play. I know we have a small position in Southwest Airlines, but we did show you why we're long Southwest Airlines and got exposure in that particular name. If you joined us on our Tuesday morning session where we talked about the difference between corporate versus leisure travel and the huge difference we're currently seeing in those trends. But you know, as COVID-19 continues to evolve and things are changing very, very quickly. So what I said on Tuesday, some of those things no longer apply here on Friday. So it's important for you to join us as often as possible every single week, because things change very heavily. So our preference right now is to utilize strategies, selling strategies. You can look at some buying strategies as well, because Clorox, I think, is a more defensive play. If you do get states that shut down, if you do get more restrictive in terms of businesses opening up because of COVID-19, you might see a quick move in a stock like this. So there are plenty of ways to play this, but the two ways that I would predominantly be looking at is selling credit spreads. Whoops. Selling credit spreads, as well as looking at buying debit spreads here. So it's trading at around 215 right now. So if I sold the 215, 205 put spread, that's a $10 wide credit spread. Notice how much premium I'm able to collect here, $4.20. I'm able to collect 42% of the width here on that credit spread. So this is really something that we want to take a look at for these types of strategies. And on the right-hand side, I'm looking at a debit spread that would allow me to take a bullish view here on Clorox. Now, one of the things that you might want to do is you might want to adjust that upper strike a little lower, depending on how far you think Clorox can go. Maybe this is not the type of stock that you think is going to propel itself to a new 52-week high and continue moving significantly higher, like some of the technology stocks. These stocks don't tend to move as far, so you might want to sell a shorter dated option or a lower strike option here. But you can make these adjustments and compare these strategies side by side. So on a name like Clorox, if it revisits its 52-week high, which is around 220 or so, as you can see here, that's really where the credit spread shines, because you don't have to have a big move to the upside and you can collect at 42% of the width, versus the debit spread, you're looking at about a 13% profit if the stock reaches back to its 52-week high. So if it goes back to its 52-week high, debit spread's not particularly attractive. you would really have to have a big move to the upside, 227, 225 or so. So even at 225, things start to look a little bit better here. So if you do think Clorox can move to the upside by a decent amount, then you might want to take a look at buying that debit spread. But right now, based on the momentum of the markets, I'm not looking for a strong move to the upside here. You know, we're heading into earnings season. We know this is going to be a very challenging earnings season. We have momentum that has shifted more to a neutral state. We have a rising number of COVID-19 cases. I think it's hard to justify to continue pull the trigger on fresh new highs on a lot of these types of stocks. I do think Clorox is a little different because this is a much more defensive play, especially in this challenging environment that we have. But for many other stocks, technology stocks, biotech stocks, difficult to continue to think that these stocks will make new 52-week highs and continue to run. So my preference here is to be more defensive and look at strategies where you're collecting a fair amount of premium, because the risk here to the downside is I'm only risking $580, which is roughly 5% of the underlying stock price. And these are the types of strategies, I'm sorry, this is only 2.5% of the underlying stock price. Those are the types of strategies that I'm trying to seek in this type of environment, because Clorox could easily pull back down to 195 or so. If I bought the stock, I'm probably risking closer to 10% of the, 7% of the underlying stock price. Here, I'm risking about 3% of the underlying stock price. Those are the types of strategies that I want to try to play utilizing this type of strategy. So that's how I'm viewing the market right now. These are the types of plays that I'm predominantly looking at. I will look at one other name just to show you guys, IBB. This is the biotech index. This is also something we talked about here on Tuesday. Biotech, very strong, leading the markets higher alongside technology. And one of the things I wanted to point out is that biotech had this major breakout here. So as you can see, going back to July of 2015, that's when the market topped at 133.50, July of 2015. And the biotech index has underperformed the market since July, but recently have started to outperform and broken out from that 133.5 high. So 133.5, 136, these are both some, 133.5 was long-term resistance, 136 was the short-term resistance that it recently had, because as you can see here, it broke out from 128, went range bound between 138 and 136, broke out to the upside, came back to retest as support, and is now potentially going to move higher here. So you really have a very strong long-term, short-term setup alongside with the fundamentals. You think about the amount of investments that have now been poured into the pharmaceutical and biotech industry as a result of the chase and the and trying to pursue a cure and a solution to COVID-19. This is part of why this industry have seen such strong gains over the past few months. And if you project out the types of moves that you've seen from even the 112 to the 128 and project that out higher, you're looking at a substantial move to the upside. And this is the type of name that where I might want to take a look at vertical spreads or even selling a credit spread to take advantage of this. And you can utilize these types of tools like OptionsPlay to help you analyze how you can play these types of strategies. So 132, 138 put spread, that's $6 wide. I'm collecting $2.22, which is well above 1/3 what I'm typically looking to collect, closer to 40% of the width here by selling a put credit spread. So that's if I think in the short run this stock is going to struggle to move to the upside. You know, this stock has range bound for quite some time. So if I'm concerned that it's just going to be range bound for a little bit of time, I'm inclined to sell premium. If you do think it's going to make a big move to the upside, you might look at buying premium. I would probably go out to August if I was buying premium here. I want to buy myself a little bit more time, especially if we talked about if you're buying premium, you are buying options, you want to buy a longer dated option. So I would be looking at something like a 132 and looking at substantially higher premiums to sell here for, or rather substantially higher. Oh, sorry, I changed the wrong expiration date. I meant to change this one to August. So I'm looking at buying a 138, 154, something along those lines. Now, these options aren't particularly cheap, but if you think that biotech can make a big move to the upside, buying a call option or a call spread might be the type of strategy that you could take a look at. Now, I know there were a lot of questions already that were submitted here. I want to try to answer a couple of questions before I open this up for symbols. So for those of you that want me to take a look at some symbols and want to take a look at them together, please type them in, and whether you're bullish or bearish on that symbol, please type that in and I'll be able to take a look. But I do want to answer a few questions here. Neil is asking, do you recommend any good books on the subject? So great books for options trading. First of all, Understanding Options, the second edition is a great one by Michael Sincere. Michael Sincere actually is a subscriber to OptionsPlay, but that's not why I'm plugging his book. It is a great book. I think it's a great book for those of you that are beginners to take a look. And then Michael Koh's Options Edge is also another one that I think for those of you that are a little bit more inclined to take a deeper dive into options education, I think is a great book. But again, a little bit more advanced for those of you that are interested in taking a look at books on options trading. So Jim brings a good point. Isn't driving your competition out of the market considered winning? Well, you might say that you might be winning on that particular day, but that doesn't stop someone else from squeezing you out of business the next day. So that's why we don't think of business as a thing that you can win. Would you say Apple has won against Microsoft? Hard to say. Has Amazon beaten Walmart? Maybe they have today, but that doesn't mean they're going to do it next year. So there's no such thing as winning. And Eric brings up an interesting question, though, regarding the finite versus infinite game. Eric is saying, though trading is a zero-sum game. Now, Eric, that might be true in products like futures and Forex, but it is not a zero-sum game in terms of equity. So I want to be very clear, and options too. Zero-sum games are only for when there are only two sides of the market. That's not true for equity. So that is a common misconception I tend to find for traders, that trading is a zero-sum game, meaning if I lose, someone else has to win. That's not true at all for equities. Tony, would you consider a trade like taking a shot in a basketball game? So great question. So going back to this, just to be clear, each individual trade that you make is technically a finite game, because each trade you will either make money or lose money. But each individual trade is not going to make or break your trading career. Your trading career is the infinite game. So yes, each individual trade you will win or lose on, but if you focus too much on winning here, what you end up doing is you sacrifice here. Every single time you focus too much on winning, what you do is you lose track of the bigger picture. And what I'm trying to teach you is don't lose track of the bigger picture. That's where I see most people blow up their accounts. In the pursuit of winning, they lose track of the bigger picture, and what they do is they blow up their accounts. So to win, most trades should follow Tom Sosnoff's comments from Thursday session. I'm not sure which comment that you're referring to. I think Tom is a great speaker, and I love having him. So I will say that unfortunately we lost the audio on Tom's session last week or 2 weeks ago, but I did book Tom again for August and in September. So we're going to be doing something really fun with Tom in August. We're going to be doing a lightning round strategy session where we're just going to blow through all the different strategies you can trade. We're going to ask Tom, based on his research, what his optimal expiration date, strike price, and how to manage those trades, the rules that he has. So I think that will be a really interesting session for everyone. I know there were a lot of questions about how to trade specific strategies. We spent a lot of time on selling credit spreads last time. I do want to expand out and cover all the different strategies. So I'm really looking forward to having Tom back here. Bob is saying, you have referred to the book about finite versus infinite game. I bought it and I'm about halfway through it. I take your point. It does change your thinking. Bob, thank you so much. I really appreciate you sharing that. I hope that many of you don't necessarily, in my opinion, have to go out and buy the book. There are a lot of stuff on the internet if you want to read about it. But I do recommend that you take a look at that. All right, so let's take a look at some strategies, some symbols together. Wayne is asking, since volatility is so high on some options, buying premium is over 10% of the stock price. In what scenario is that a good move? Great question, Wayne. So this is actually one of the questions that we discussed with Tom was, when do you buy options, right? And Tom specified that he only buys options when implied volatility percentile is below 10, which it is not right now. Implied volatility percentile is actually quite high. So the premium of options are very expensive. And the only other time that he buys options really is when volatility is extremely high, which it's not at either right now. So we're kind of right in the middle. It's really relatively elevated. It's not too high. It's not very low. So that's why, again, we prefer to be selling premium at the moment. All right, so let's take a look at some symbols together. Let's see. Someone wants to take a look at CLDR. I have no idea what CLDR, Cloudera. So a lot of the cloud stocks are very interesting plays at the moment. You know, very strong stock from a technical perspective. 1 month and 6 month trend is bullish. These are generally strong indicators that I look for when I'm looking for a bullish opportunity. But as you can see here, the options are probably quite expensive. So certainly like the stock from a setup perspective. I don't know much about it, but options are, I would imagine, aren't particularly liquid and not particularly cheap. Robert's asking for SYY Cisco. Cisco, I believe, if I'm not mistaken, this is the food staples company that services predominantly wholesale and restaurants and things like that. Very neutral chart, you know, relative strength is weak and weakening. The 1 month and 6 month trend is mildly bearish and neutral. You know, I don't particularly have a strong view on this particular name. I don't know a whole lot about this name, so unfortunately, I don't really have a lot to add, unfortunately, Robert. INO. I got asked this question. I got asked this stock, I think yesterday. You know, it's interesting. The stock broke out from this massive, let's just call it triple top, right? You have this triple top, broke out, and it hasn't really looked back. But as you can see, the options are really all over the place. First of all, I don't think they've listed enough options. It only goes out to 35 if we go out to August. Yeah, they just haven't listed enough options. You know, the stock has really taken off and they haven't listed new options. So if I was trading this, I'd probably trade the stock, but you know, the options, I just don't think they have enough symbols on it. So I will say that I want to try to take a look at names that are more large cap names that everyone can understand, that everyone follows. You know, I try to stay away from these small cap names, especially when I know the options aren't very liquid, and Eldorado Gold falls into that category, unfortunately. But I will make a comment here on GLD. GLD, this is also something that we've been talking about for a while, finally broke out above this 165 level. I've been watching gold for quite some time, finally broke out, came back to retest this as support. And the question right now is whether or not gold can rally. You know, one of the things is that you can buy some call options or a call spread here on GLD for a relatively small amount of capital, $293. That's 3% of the underlying stock price. It's a relatively cheap way to play for upside here. Gold doesn't move a whole lot. That's part of why the options are relatively cheap. But I do like this breakout as more of an inflation hedge, long-term view here on gold, in my opinion. So I like some of the mining stocks, but I don't like trading the individual mining stocks because they're almost all small cap. I like trading GDX rather, the ETF, which is a little bit more, which is much more liquid as far as a name. So if you want to play the gold miners, I prefer using GDX rather than playing the individual names. Joan wants to look at TDOC. So I've talked about TDOC quite a bit. You know, I certainly think that there's more of a fundamental case for this particular stock. When I was looking at TDOC, I think this was probably back in April on CNBC on Options Action. This was when we thought that COVID-19 was going to roughly tail off by June, and that the number of people that are going to seek telemedicine is going to taper off as well. That doesn't seem to be the case at the moment. So I do think that you have a longer term support here for TDOC. And you specifically notice that it's just been, you have this triple top here, or double top here rather, at 195. It broke out and is now potentially moving higher. So technically, I like this. Fundamentally, I also like this, but be careful about the options. These options aren't really liquid. And my preference would be more to consider selling a call vertical here. I'm sorry, a put vertical here, where I might be selling something like maybe a 200, 185. As you can see, this is collecting $6.50, which is almost 40% of the width, a little bit more than 40% of the width. Those are the types of strategies that I think I would play here, utilizing TDOC, and especially when premiums I'm sorry, implied volatility is relatively elevated. Someone wants to take a look at Amazon. I still like Amazon. I will say I started taking profits on some of my positions after it broke out above 2,700. Just to zoom out a little to give you some context. Whoops. Sorry about that. So, you know, one of my concerns about Amazon is really just the moves to the upside. We've seen quite a bit of negative divergence. So as Amazon continued to move higher, momentum could not confirm that move higher, which is part of why I started to take some profits on this. I still like Amazon long-term for the fundamentals, but short-term positioning, I just thought was a little stretch here. I would prefer to see a revisit back to the 20-day moving average. As you can see, 20-day moving average, fairly consistent by the dip type opportunities, but as you can see, we're pretty far stretched above that. I don't like going long when it's this far above its moving average. I like to see a pullback to or potentially even below that moving average before I like to go long. So that's my view here on Amazon. Long term, I like it, but I'm not particularly, I'm not as favorable on the current levels. Someone asked me about CVS, and I just think this stock is so neutral at the moment. I just simply don't have a view on it. It is underperforming the market. It's underperforming the sector. It is not the type of name that I like to play when something's underperforming both the market and the sector. But at the same time, I'm not bearish on it. I don't think it's time to go short CVS. So I don't particularly have a strong view here, especially for a buy, just because of the poor relative strength here. Pfizer has been predominantly very weak here, and it continues to be weak. You know, if you are trying to press a short here on any type of name, these are the types of names that I would seek, something that continues to be weak, week after week, and is likely going to target this low here around 28. You know, again, my preference is not to short this market, but if you are going to short, this would be the type of name that I would be looking at. Costco's still hovering at that 300 level. You know, Costco has really been a bit of a boring stock, hovering at this 300, 315 level. Not a whole lot of movement. And I'll be honest, I'm not particularly sure as far as where I think Costco is going to go, because if you look at their business model, predominantly they make 80% of their revenue from memberships, not from people buying things. They make actually very little money from you buying things because they're selling it almost at wholesale prices. But they make 80% of their revenue from memberships. Are people going to continue to maintain their memberships as you have 30 million unemployed people? My thesis was that wasn't going to happen, but Costco stock has not taken a decline. So my views are, I'm a little bit more bearish on the stock, but the stock hasn't broken below 300. I need to see a break below 300, but even on a break below 300, the next support level is at 280. That's not a big move to the downside on a $300 stock. So I'm not trading Costco at the moment, but those are my views. POWC, I'm not sure what that is. Is POW the symbol or is C the symbol? I'm guessing you're asking Citigroup. So financials, I actually think financials are interesting because they are quite cheap from a valuations perspective. You know, you have this fairly strong technical setup here where you have this, you know, you have a lot of the same setups in many of the other banks where you have now some support and potentially you might get a move to the upside. The only concern that I have with Citigroup is the options are really expensive. I do like Goldman Sachs a little bit more out of the banking group. The stock also looks a little stronger, but options also quite expensive. So especially after banks are up about 2% today. That was on the news about the capital requirements of banks. Eli Lilly, short-term bearish. You know, I certainly don't have a bearish view here on Eli Lilly. It is relatively strong stock. You do have this double top here. Maybe it revisits this, you know, this fills in that gap and then perhaps moves higher here. But, you know, strong relative strength, 1 month and 6 month trend is bullish. Those are generally not the type of stocks that I'd like to short. Applied Materials. So Applied Materials out of the semiconductor stocks is one of the, I would say, boring stocks, but probably better to be boring in the semiconductor space. Applied Materials doing very well. You know, I particularly like NVIDIA a little bit better and AMD a little better in the semiconductor space. I don't know a whole lot about Applied Materials. They are a relatively smaller semiconductor stock, but very strong uptrend here. So those are the types of stocks that you like, but as you can see, options here, very expensive, also not very liquid. So that is some of the concerns that I have about Applied Material. John wants to take a look at Spotify. Spotify has had some pretty spectacular moves to the upside. Let's just call it that. I'll be honest, I don't think that the revenues justify the moves that we've seen here in this particular name. I do think this is an example of a stock that has gone maybe a little too far, too fast. Let's take a look at Spotify here. So, you know, from my perspective, the negative divergence here is concerning to me. You know, you have this huge move to the upside where momentum barely budged to the upside. So I'll be honest, this is not a stock that I really fundamentally understand why it is rallying this hard, this fast. You know, it's certainly not like a Tesla type play where I can see a long-term view on this. It's not, that's just my view. Kroger taken quite a bit of an interest over the past couple of days as coronavirus cases continue to rise. But this is the type of stock where I just don't see big moves. I don't see Kroger making big moves to the upside. If you are bullish on it, I would sell put credit spreads because the stock doesn't move. But I also feel that because the stock doesn't move, you're not going to be able to receive much credit. I've looked at this stock multiple times. I haven't been able to find what I would consider an attractive put spread. As you can see here, this $4 wide credit spread only collects 60 cents. Not worth my while. So Kroger, I don't particularly love or hate the stock, but just from an options perspective, not much to do here. Manny thinks that there's going to be a 25% correction in Zoom. Okay, so if you think that there's going to be a 25% correction in Zoom, there's only one way to trade that, and that's buying a put spread. Buying a put spread, 25% move to the downside is another 50 points to the downside. So I would go out to August and I would buy something like a 260 or maybe even a 250, 200 put spread. It'll cost you $1,500, which is a little bit more than 5% of the underlying stock price, 6% of the underlying stock price. If you're wrong, you're risking 6%. If you're right, you're going to make 220% return on your capital if Zoom does correct that 25% to the downside, down to the 200 level. So that's how it would play if you're bearish here on Zoom. FSLY. I don't know this name, so Fastly. Sorry, I just know nothing about this particular name, so I really can't comment on that. Zoom, you know, I will say Zoom does look a little too far too fast. I mean, if you look at the growth in terms of Zoom revenues, it does not match up with the stock chart. I talked about Zoom when it was trading at 100 and on options action back in late February, early March. And I said that this is a stock that's misunderstood. I think this is a stock that many investors, I think, didn't understand the potential of Zoom, and that was when the stock was trading at 100. The stock has had roughly 200% growth in terms of revenue, which doesn't justify the growth that it certainly has had in the stock, in my opinion. So I do think that the stock may be due for a correction. especially when you think about Microsoft Teams trying to get into this particular space. So those are my views here on Zoom. Can you review the width parameters? So if you're referring to the width of a credit spread, Alan, credit spreads, you always want to sell roughly the 50 delta and buy back the 25 delta. Now, Tom Sosnoff last week says he likes to sell the 35 and buy the 10. The two strategies are fairly similar to each other. The 35-10 would obviously have less premium, but it does have a higher probability of profit. So that's the trade-off that you make. From my trading, from our back testing, we certainly prefer to collect that higher premium. It provides a bigger downside protection when the trade goes against you. You're taking on slightly less risk for that trade as well from a percentage perspective. So we prefer to trade something that has less than a 2-to-1 risk to reward ratio versus when you sell the 35-10, you generally have at least a 2-to-1, sometimes a little slightly greater than 2-to-1 risk to reward ratio. So we don't particularly love that. AMD bullish. This is a stock that I really quite like out of the semiconductor stocks. You know, you have NVIDIA that really has taken off versus AMD. AMD has just consistently chipped away at Intel's market share of the personal computing space. They're starting to chip away into the server space. So from a semiconductor stock perspective, I actually quite like AMD versus Intel. Chart for the two looks relatively similar, and AMD, you know, has really kind of found a bit of support here around 52. So my preference here is to sell put spreads here on AMD, something along these lines where I'm selling maybe a July 31st 52 47.47 credit spread. That's five points wide. I'm collecting $2.05, a little more than 40% of the width. That's the type of vertical spread that I kind of like here on AMD. Vale, I don't know a whole lot about Vale, V-A-L-E. Vale, which I believe is the mining stock, certainly from a chart perspective, actually looks fairly constructive. You have a breakout here from this particular triangle. It's ran up here, consolidated for some time. You have a bit of a, let's just call it a flag, if you will. Now it hasn't broken out to the upside yet, so I would wait for that breakout before I would be looking at going long here. It hasn't broken out from that flag. So you do have this consolidation flag. That's usually good, because after a big run up like this, you want it to consolidate for a while before you see that move to the upside. Now, you know, this moved from about $8 to 10.5. So you have another 2.5%, $2.50 move to the upside. That's about 25% of the underlying stock price. So you have a lot of upside, but my preference is to wait for that breakout before you go long, especially if you're looking at those August calls. Bob is asking if I can look at SO. So SO, utilities have been particularly weak. I haven't looked at SO, but very similar chart. You do have some some support here around 52, but again, utilities hasn't been particularly strong. You might get a move up to the $60 level. If you're bullish here on SO, my preference would be, again, selling put credit spreads. But I will say on a name like this, I don't think sometimes you will be able to find a good one. So let's say I sell a 51.48, which is $3 wide. If I do that, I'm collecting 99 cents, which is one third of the width. So that's the bare minimum I'm looking for. Not a particularly attractive trade in my opinion. So not my first choice in my opinion. Amgen. So as far as the pharmaceutical names and the medical names, you know, my preference is not to pick individual names. I think sometimes it's a bit of a crapshoot picking individual names here in this particular sector. Amgen, very neutral stock, doesn't have a particularly strong, you know, bullish or bearish view. I don't have a strong take here on Amgen from a fundamentals perspective, so I don't really have a whole lot to comment here on Amgen, unfortunately. Prince made a comment, winning the infinite games mean the game is not over, and goes on. That's absolutely correct. The game continues to go on, and it never ends. So there's no such thing as winning. The whole goal is to just stay in the game. Please look at Wing and BLK. So I don't know what Wing is, but I will take a look at BLK, BlackRock, major asset manager. Major double top here around 550, if you will. So from my perspective, let's look at this a little bit. BLK. So, you know, the thing about BLK is that it really has underperformed the broader market for years now. It hasn't been able to perform on par with the markets. It's back at that 560 level. And my biggest concern is that as it kind of approached that level, momentum started to slow down. This is not particularly strong for BLK. If BLK can manage to break above 560, 570, then I think you have a much better case for a bullish view here on BLK. But if you look at the asset managers, you know, fees aren't particularly moving in the right direction for asset managers. Interest rates are not moving in the right direction for asset managers. So for those reasons, I'm not particularly strong. But if you do get a technical breakout, that would be a different story, but I don't see that right now. Someone else noticed the soup cans behind Tom on that. I completely agree. Those are very interesting soup cans on Tom Zosnov's background. For those of you that noticed it, I will ask him about that next time. So Dow Jones Industrial, very weak compared to the much weaker compared to the S&P, has not managed to reclaim that the relative highs. So, you know, back here in July and back here in September in the breakout, you know, DIA, this was 273, and it has not been able to reclaim that. It looks more like the small cap index from that perspective. If you look at small caps, relatively same thing, still below those levels. So Dow Jones Industrial looking very weak here. My preference is to stay away from this. DIA. My preference is to stay away from the Dow indices, focus more on NASDAQ, focus more on S&P. Those are the ones that I would pay attention to. Put selling delta 15 to 20 is better than 50. Well, we're not talking about selling puts here. We're talking about selling put spreads, which is a little different there, Bernard. Angela's asking, how can I better learn to cut my losses? At times I've been happy, I stayed with the trade and was profitable, so it messed with my psyche. What are your rules around this? So if you've lost more than 50% of the premium or 50% of the max loss on a trade, that's usually a good time to cut your losses. Yes, in very few events that you may get yourself back to break even if you've held on to it longer, but you'll find that probably 70 to 80% of the time that when you've lost 50% of the max loss or 50% of the premium that you've paid, that is likely going to result in a full loss 70 to 80% of that time. Thoughts on Baba long? So Alibaba, I think, has been pretty strong here. It has been. But you do have this major double top here around 230 or so. And one of the concerns that I have with Baba is that as it continues to move higher, you know, really for months on end, momentum continues to move sideways. It hasn't confirmed these moves to the upside. So, you know, if you want to be very short term, as you can see, Baba does, when it reaches a 20-day moving average, have, you know, moves to the upside, but they only last for a couple of days. These are not particularly great trades for options unless you're extremely tactical and you're buying and selling almost every single day or perhaps even intraday. Difficult trade to stock, difficult stock to trade because the options also, in my opinion, aren't super liquid. So sometimes getting in and out of this name sometimes is a little difficult, but that's my view here on Baba. Michael saying, Tom had a good comment. Winning is a habit. He tries to cultivate that. I absolutely agree, Michael. And you know, when he said that, that made me think a little bit about what we offer here. And I certainly think that we will also be making some adjustments off of that because I think he made a very valid point. Okay, so I've gone through a lot of names, and I know there are so many more names that people want to take a look at. Okay, I'll try to take a few more names here since so many of them. So many of you have contributed, and I really want to try to get to as many as possible. And this is part of why during the Ask Me Any session, I'm asking you guys to submit questions ahead of time because I want to try to address as many as possible. I really appreciate everyone participating here every single Thursday, asking questions, giving me your symbols so that we can all look at things together. This is all designed to help you guys better understand how to trade options and how to analyze the market. So I really want to try to spend as much time as possible to go through all of these symbols that you guys have taken time to submit. So Fiverr, Interesting stock. You know, you have a stock that probably is going to do relatively well during COVID-19 as you have more freelance people or people trying to find freelance work. Generally a little bit more international, a lot of exposure to Asia, to developing countries, which very well might be, you know, a good place to, you know, for freelance work at the current moment, as there's probably a lot of unemployment in this particular cases. You do have a nice triangle here. It hasn't broken out yet, but I would watch that. Oh, actually it did break out today. It's trading at $74. So this might be a good opportunity to go long in this particular stock. So let's look at Fiverr. So it looks like you did get that breakout here today. So if you can sustain this level above that 70, 72 level tomorrow and maybe retest that as support, that might be a good long here. But small cap stock, be very careful. I think that you might have trouble trading the options on that. DocuSign, very strong stock. DocuSign, I think, will continue to be strong. Very similar chart setup to Zoom, kind of gone a little bit parabolic. I do have concerns about the fact that momentum has moved sideways throughout the entire time that it's moved up. That is usually a concern of mine, telling me that this stock is going a little too far too fast. So if you like the stock, you might wait for a bit of a pullback here. Tesla, I like Tesla. It has really struggled for this $1,000 mark, if you will, but today's bounce off the 20-day moving average is encouraging. I actually was looking at this stock earlier today, especially when it was trading near that 20-day moving average. It's pulled back, it's consolidated, which is what you generally want to see after the stock kind of has this rally. You've got this consolidation. You want to see a breakout here to the upside, but I think if it breaks out, you have substantial moves to the upside. But I do want to warn you, weekly chart, huge negative divergence. You know, you have quite a bit of a potential pullback here in Tesla. So I'd be very careful. If you're going to play for upside, use call options, use call spreads, so that if you do get this 20-25% pullback, you're not exposed to that. You're only risking a smaller amount of your capital to do so. Let's look at MU, Micron. So Micron, you know, semiconductor stocks, like I said, relatively isolated industry to COVID-19. And if anything, has a bit of a tailwind from COVID-19. MU trading near the bottom of this range. So if you like semis, I certainly think MU is one of the potential candidates. Again, my favorite in the conductor space is NVIDIA and AMD, but Micron, Micron, Texas Instruments, both of these I particularly like, but Micron, I think that, just from a technical perspective, I actually quite like this setup because it is trading near the bottom of that range, and you do get a move to the upside of that range, you might get that relatively quickly. Etsy, one of these stocks that have really taken off after the coronavirus here. You've had this recent consolidation range, broke out. I'd like to see a little bit of a check back before this continues to move higher, but I do think this is one of the stocks that will continue to do well in this current environment. AMT, is that American Tower? Yeah, it is, the REIT. REITs, I don't know a whole lot about this particular name at the moment. I haven't followed it. I haven't traded this name in a while, but you do have this major resistance level that is now support. So I don't know how much higher it can go. It doesn't pay a particularly strong dividend for a REIT. So my preference would be, if you are interested in this, take a look at seeing if you can sell a put spread here. Maybe something like a 250, 240 or 250, 235. These are not very liquid, so be very careful. You're only collecting less than 1/3 of the width here, so not very attractive in my opinion for AMT. Goldman I already looked at, GDX I already looked at, McDonald's, I liked McDonald's, but then the volatility, I mean, the momentum on it really started to shift lower here. So I'm not sure I'm as bullish here on McDonald's. You know, I liked it on the breakout. I actually went long on it in the breakout, and then the momentum just fizzled, and it's back into that range. So you know, from a fundamental perspective, I quite like McDonald's. And, you know, now from a technical perspective, perhaps, you know, this is a different way to view McDonald's and you think it's going to move higher. But, you know, the 1 month and 6 month trend is bearish now. The relative strength really bugs me about going long on something that's relative strength is continuing to fade. But if you play this, the best way to do it, in my opinion, is to use something like a call spread here, something where you're risking, in this particular case, you're risking 3% of the underlying stock price, 4% of the underlying stock price. You know, because I do see if this thing corrects, you do have a lot of downside here. So I would prefer to use call spreads here to buy McDonald's. Uber, you know, I like Lyft more than Uber, but again, momentum has not been on our side here for this particular trade. I still like Lyft better than Uber, just from a, you know, the company is more focused, if you will, on transportation. It's more focused on rideshare. Uber has a lot of ancillary businesses between Eats, between trucking, between all the other things that they're trying to do here. So I think Lyft is more focused. I like that name a little bit better. But here, I'm just like Lyft, I prefer to sell premium here because I don't know that you're going to get this big acceleration to the upside that you need to buy calls with. I think you're better off selling puts, or put spreads rather. Disney, you know, I really liked Disney earlier this week, but again, same thing. Momentum is really starting to shift to the downside here, especially with Disney parks not looking particularly strong here. You do have this major gap that is just about to fill here around 109. If it breaks below that, I think I would be turning around here on Disney. If it holds it, you might get a move to the upside, but right now, I think the risks are skewed to the downside here for Disney, so I'm not particularly as bullish here on Disney. Facebook, I actually really like Facebook, but has underperformed, you know, the FANG stocks. It hasn't taken off like Apple or any of the other guys, but I do like Facebook for, you know, especially if you think about Facebook versus Google. I like Facebook a little better from an advertisement play perspective, but I would also be selling credit spreads here on Facebook rather than buying any type of calls, because I do think that there are limited upside here for stocks like Facebook. Target has been particularly strong, especially in a uptick in terms of COVID-19 cases. I think Target is going to be relatively strong, but again, selling put spreads would be my preference. The casino stocks, FYI, ERI is casino, not the gold stock. I'm not sure I understand that. Eldorado Resorts, I don't know anything about this particular resort, but options aren't very liquid on this, so I wouldn't necessarily touch that myself. But if we look at something like Wynn or Las Vegas Sands, which Las Vegas Sands, from my perspective, is probably the stronger of the casinos. What I really don't like about the price action earlier this week is that you had a pretty nice steady uptrend and then it broke below that uptrend. That's not strong. ERI certainly looked a little stronger from my perspective, so perhaps this is a slightly different. They obviously have different exposures than Wynn or Las Vegas Sands. Maybe looking a little stronger if you want to play for a move to the upside. Okay, so many more. I really appreciate you guys taking the time out here. I've talked about Tesla here. Let's see, UAL, United Airlines. This is, you know, the airlines have really had its wind taken out of them. I'm really not as bullish here on airlines as much. I do think that if you are going to play the airlines, stick with the domestic discount carriers. We showed you the research on Tuesday. It is very clear corporate travel is not upticking at all. Whatever uptick in terms of travel has been predominantly in leisure travel. And I do think that the states imposing self-quarantine in many of the states is going to put a bit of a damper on even leisure travel. But in the leisure travel space, you have Allegiant, you have Spirit, and you have Southwest Airlines. Southwest Airlines, from a financial perspective, looks the strongest. That's why we took that small trade on Southwest Airlines. Here, it's still, you know, just slightly, just sitting above our break-even price at the moment here. But, you know, out of the airlines, I'm not as bullish on Delta, United, and American because international and corporate travel is not coming back anytime soon. They are the most exposed to that. And they have a fair amount of debt compared to a smaller regional carrier focused on leisure travel and discount leisure travel, such as Southwest Airlines. TWOU, that's 2U. I've looked at this stock before, but I don't know much about it. You have this nice consolidation range here. I would like to see a breakout of that range before I look for a long or short opportunity. Call options here are very expensive, so be very careful. Any comments on AMD? I think I went over AMD, GS. GS taking a dump here. I haven't looked at GS today, I'll be honest. I've been pretty busy today. Did GS move after hours? Oh, it did. Down 201 after hours. Okay, so it looks like the stress test did knock down the stock a little. We'll have to take a look at that tomorrow. I haven't had a chance to see this. Merck's MRK. Whoops. Merck's was one of the names that we weren't particularly bullish on earlier this year, or I'm sorry, a couple of months ago. And the picture doesn't look particularly strong again now. You have this range that it's been trading within that it looks like it's trying to break out to the downside, but until it breaks down, I'm not looking to take any positions in this particular name. VMware, this is an interesting one. VMware, this is the type of stock that would do very well in a work from home situation. This is the stock that we are looking for a breakout from, but it hasn't broken out. It looks like it's actually taken a bit of a move to the downside down to 149 or so. So I would look for a breakout here before I would go long here on VMware. Snapchat. Oops. Snapchat, oh, I haven't taken a look at this stock, but it really has taken off here. Snapchat is, you know, this is a stock that we've liked for quite some time. I actually wasn't expecting it to be this strong in terms of the chart. Let's just take a look at this a little closer. So same concern that I have here on some of the names here is that I think this does feel to me a little too far too fast, especially if you look at momentum, not quite confirming the move to the upside. You don't have negative divergence, but I do think you have a very high probability of a short-term pullback here. I would prefer to go long here on a pullback rather than continue to chase this to the upside. AXP bear put spread. So I talked about AXP on our call on Tuesday because I think there's going to, AXP is very heavily exposed to corporate travel, and corporate travel, as we saw in the research, is down 90% and is not recovering at all, despite the fact that travel is starting to slowly creep up. And if, you know, when I talk to my corporate clients and I talk to everyone in the corporate world, it doesn't seem like anyone's going to be traveling anytime soon. So I do like the idea of a bear call spread here on AXP. From a fundamentals perspective, but I will say American Express, looking at very similar to some of the other names, I am wary of shorting when it still stays above this $96 level. If it gets below 96, that's when I think you have a lot more room to the downside. But at above 96, you know, especially after a big move to the downside, you don't like to press shorts after it's made a big move. You want to wait for a bounce, then short. So that's my view here on AXP. I like the trade. I like the view on the trade, but I don't like the timing on the trade. I've already talked about pretty much all of this name right now. Okay, so I genuinely tried to get through as many of your symbols as possible. I unfortunately can't get through everything, but I really tried to get through as much as I possibly can. I really appreciate everyone for taking the time out here this afternoon. I hope that you guys find this useful. You know, we try to do these once a month where instead of me talking about what my views are and what symbols I want to take a look at, we want to do this so that you guys can submit the symbols that you want to take a look at. And I'll show you how I'm viewing the markets and how I would potentially look at the options and which ones I would trade, which ones I wouldn't trade, for what reasons, how I would trade them. Those are the types of, and you know, this is really designed to give you insights into how to position yourself in this particular market. It is a difficult market to position for because things are changing so quickly. Volatility still remains very elevated. It's difficult to position. Be careful. So one of the things I do want to make sure that, you know, a lot of the requests that came in today were for symbols that I would consider not very liquid. So at the bottom of your screen on OptionsPlay, there is a button called liquidity, right? Liquidity is so important in this market, especially when volatility is relatively high and things are moving. You need to be able to get in and out whenever you want to get out relatively quickly. So liquidity is very important. So I highly recommend you that when you're trading, in your morning, when you look at your symbols, you take a look at what symbols are very liquid. So as you can see here today, there was 200 and let's see. Wow, a lot of very liquid symbols, almost 309 symbols, a lot of very liquid symbols. So very important that you keep an eye out for this in order to understand where you find liquidity, because you generally want to focus your options trading in those particular names. If you're trading in other names, there's nothing wrong with trading small cap names, but you want to be careful if you're trading options on those small caps names, because you may have trouble getting in and out, and you certainly would have trouble getting in and out at what I would consider a reasonable price. You might have to pay a lot more to get in and sell it at a significantly depressed price to get out. So be careful of that, because you could then give up all of the gains on your research due to transaction costs, and you don't want to do that. So you want to make sure that you do your research, make sure that you spend your time understanding what you're trading before you go ahead and place that trade. So with that, I just want to thank everyone for taking the time out here this afternoon. Thank you so much for all of your support for our members to allow us to continue to do this every single week. Like I said, I'm really excited to do the Ask Me Anything session next week. We're actually going to limit the number of people that can attend that to 1,000 people so that I can try to get to all of your questions. Sometimes it's so difficult to get through all of the questions because there are so many, but I do appreciate everyone taking the time out. If you want to consider supporting us, you can become a member by clicking on the link that I sent you in the chat window at trade.optionsplay.com/member. Membership is just $75 a month or $500 a year. Gives you access to everything, the tools, the research, the weekly market commentary, the daily market commentary that we send out, me and Prakash, now that we've added the income commentary. This is all designed to give you a full experience on trading options, no matter what type of options trading that you do. So with that, I just want to remind everyone, there were a few questions about how to get access to the recordings. Please follow us on YouTube. That is the best way to get access to all of the recordings. You can follow us on our YouTube channel. You can subscribe and then just click on the notification bell. And every single time that we post a video, you'll get a direct email from YouTube letting you know that we've posted something. That's the best and the fastest way for you to get access to all of our recordings. And again, what I'll be doing is an Ask Me Anything session here next Wednesday. So next Thursday, we're not going to have a session because it's going to be right before the July 4th market holiday. So you can sign up for the if you're already signed up for this session, then you already have access to the Ask Me Anything session next Wednesday. But you can submit your questions for Ask Me Anything for next week using the link just posted into the chat window. I highly recommend that if you want me to answer your question, that you submit your question ahead of time. I will answer questions live that I have time to do, but I will prioritize the questions that you guys submit ahead of time. So please do that. And again, this is an Ask Me Anything session. You can ask me anything under the sun. Nothing's off limits. So I hope that we have a bit of a fun session next Wednesday on that. So thank you so much. I hope you guys have a great evening. We will send out the recording to everyone after we finish here today. And tomorrow morning at 9 a.m., as always, we will be doing our Friday morning market outlook session. You can sign up for that using trade.optionsplay.com/weekly, which I will post a link to that into the chat window as well. So thank you so much. Have a great evening, and I'll see you guys tomorrow morning.